It is November 23rd. We had a few days off while we went to Muscat and the return of the Oman Energy Forum, which we were producing there earlier this week, back in Oman for the first time in 3 years. So it was great to see everybody there. All things well in Muscat, the energy industry in a very healthy place at the moment, and the macro fiscal situation in Oman, of course, much more positive, given the fact that we're entering a year in which $100 oil on Brent has been the average price. So all boats rise in that situation. Let's kick off this morning with Brent crude trading today, actually below $90 a barrel. We had that drop in the last few sessions, and it's sort of staying there. Let's start this morning with Sarah Akbar and get Sarah's view. Of course, Sarah is chairperson and CEO of Oilserve Kuwait and non-executive director of Petrofac. We had some of your Petrofac colleagues actually with us in Muscat, Sarah. But your thoughts as we sort of approach 2 weeks now from the next OPEC Plus meeting. We've had different stories bouncing around. What do you think is in their consideration as their next step?
Well, I think, after the announcement of the 2 million barrels cut, I don't think that they will go and cut deeper now, even though the oil price is a little bit below the 90. I think 90 is around the number they were targeting, although they said, I don't know if you heard a couple of in the discussions. So the claim is that we are trying to stabilize the market because they foresee that there will be some surplus in the market, and then this creates volatility, and volatility is not good for their business. So they're trying to create some uncertainty in the forecast, and that's why they brought in the 2 million barrels cut. Now, going forward, I think it will be very difficult to go and do deeper cuts because we all know that even with this 2 million, it is not a real number because many countries actually are not able to meet their quotas, and to go again and go on the same row, and the implications to that announcement were great because it created stress between the US and between Saudi, and people started pinpointing finger to each other, and I didn't say that, we didn't participate in that, we were pushed to do so. So I think status quo will be the theme of the conference, and they will continue with this decision and into next year, because practically speaking, it is not possible for them to go and cut more now, except if Saudi decides to do it so that to keep the price, which will antagonize more people going through the winter. So that's why I feel they'll keep the 2 million, and that's it.
Ahmed Mehdi, Research Associate, the Oxford Institute for Energy Studies, up bright and early this frosty November morning in London. Thank you so much. Your thoughts, Ahmed, 2 weeks out from the OPEC Plus meeting. Do you share Sarah's views? A very determined Saudi Arabia to keep that Brent price above 90, although they never say it, I know, but ultimately their language is we need a balanced market. A balanced market seems to translate to $90 a barrel. Your thoughts?
Good morning, Sean. Yeah, very bright and early. First thing to
maybe not so bright, actually. It's 6:30.
Not bright. Very, very early.
Dark and early and grey and wet. Okay, we've said it. That's it.
Yeah, I think obviously the sort of sensitivities to what's happening now in the market. You saw on the reports that came out this week from a newspaper about what might happen with OPEC and Brent and TI shedded a couple of dollars on that news, and then suddenly it was dismissed, and prices returned. I think in terms of the timing, not just in terms of when the OPEC meeting is ahead of the EU ban, but also the timing of the EU ban itself with crude versus products is also very interesting. So crude being one set of equations that have to be considered, and then products having another set of impacts relating to what might happen with balances. So I agree that to to deepen cuts even further, as you said, the pool of candidates who would actually, execute those cuts is a very narrow pool, and UAE would have a very different attitude. For example, Russia itself is already producing way below, and I think the question really is going to be about all the different complexities that surround what the future direction will be for Russia, in light of dirty tanker capacity constraints, in light of the price cap proposal, which I believe the number is coming out today. And then you've also got recently some news about how there may be a sort of, certain caveats applied to how the price cap is executed. So in terms of restrictions of those carrying crude outside of those insurance mechanisms. I think that the other important equation that probably, I mean, the way I would put this more generally is, is there enough strength in the market right now to sort of protect a floor price? I think that's the kind of key issue. And I think
is there enough in terms of the demand, you mean?
Yes, exactly. Sorry. What I meant is that, the market's not, exceptionally weak, but obviously there is a couple of kind of things going on out there. And I think also at the same time, yes, China is relatively weak, but it's not going to be in this zero COVID situation, indefinitely. It's a very expensive policy to maintain. And
well, they seem to be wedded to it like a barnacle on a rock, sort of in defiance of, as the saying goes, cut off your nose to spite your face sort of scenario there. Let's go to Ed Bell, Senior Director of Market Economics at Emirates MBD here in Dubai. Ed, I'm quite keen to get your sort of overview as we come to the end of the year before the sort of silly holiday season disrupts everything, and maybe it has already. But what's the fiscal health of the Gulf from your perspective? Inevitably positive, but my question is more, do they see this year as a bit of a windfall like the oil and energy companies? It's a one-off, but they haven't got back to this sort of $90 trend. I need it to continue. Are they still on a diet of 70? I mean, your thoughts on how addicted they are and need are they to this year's average?
Yeah, thanks, Sean, for having me on. That's an interesting point, because I think they certainly have the appetite for $90 and above in terms of the benefit that it accrues to the overall economy, to the fiscal health of the governments across the GCC. But the governments are still kind of behaving like it's a $70 oil price environment. So I think we have taken quite a few steps down the fiscal reform side in the last couple of years. We still have 15% VAT in Saudi Arabia. We haven't really seen any kind of easing in terms of the tightening of fiscal policy that has been enacted in the last couple of years really being rolled out. We had a little bit of loosening earlier this year in both Saudi and UAE related to kind of cost of living adjustments, but the scope for who is eligible was quite narrow. I think in the UAE, you would have been talking maybe in the kind of tens of thousands of people that would have been actually eligible to receive that assistance. So all in all, I think as we come into the end of the year, the kind of headline fiscal position of the GCC en masse is very strong. The idea that you have countries like Kuwait or Bahrain or Oman in a position where they're running big fiscal surpluses after what we had really become accustomed to very tight or very wide fiscal deficits is really quite astonishing. And that's without having done as much maybe fiscal innovation that we've seen in, say, Saudi or the UAE. And certainly we are getting more interest in terms of clients who are looking again at Oman in particular, not so much as okay, what is the conditions where Oman needs to, in the last 5 years, the question was, when is Saudi, when is the UAE, when are they going to step in to help support Oman? We're not really getting those questions anymore. It's more a question of, what is the kind of future, more positive, more optimistic outlook for Oman going forward? Certainly still very attractive from a debt investor point of view. So all in all, I think we are coming into the end of year in very good fiscal footing. I don't think that there's necessarily a move to ease back on any of the kind of fiscal changes that have been made. The challenge now is that, yes, the oil prices are high. They've taken some good steps. You've diversified revenues, but going down the route of raising capital via debt markets has become much more expensive. So anybody, even if you're a good credit like, Abu Dhabi or Qatar or Saudi Arabia at the sovereign level, or any of the kind of big GREs that are linked to the sovereign, you've got, an additional 50 to 100 basis points onto your spreads compared with where you were at the start of the year, simply on the back of US rates going higher. So that might fall a little bit flat in terms of the source of revenue over the next couple of months, at least until we get to a peak in the rate hiking cycle in the United States.
I just wanted to touch on some latest developments in Sarah, in the Kuwait. We had obviously the news this week that Kuwait's new Al Zour refinery has sold its first fuel oil cargo. This is, of course, a massive refinery, 615,000 barrel a day capacity. The outlook for that in terms of its ramping up and Kuwait, what it means for Kuwait.
Well, and initially this refinery was built to supply the domestic market with fuel oil for the power plants. But since that time, things have changed completely because all the new power plants are gas fired, and as you know, we are importing LNG to utilize the gas for the power plant. So there is plenty of surplus and products that are coming out of this refinery. That's why the target for the output from this refinery changed from being a domestic use into actually selling into the market. So there is plenty of products that will be generated by this refinery to supply the market. Now, the initial commissioning of the refinery started actually last year or the beginning of the year, but now they have the units operating. It's not fully commissioned. It's not all the units, so there is still some work to be done. But I guess towards the end of the year, beginning Q1, it will achieve the capacity 600,000 barrels a day. So that will be a big relief to the product market in the whole region, I think.
And also this month in Kuwait, Sarah, the announcement of Wadha Al-Khatib as CEO of KNPC, the refinery operating company. I think that's the first woman to run the company. Is it, or is that a significant sort of glass ceiling breakthrough?
So this year, this round, we had two women actually. We have Wadha Al-Khatib running KNPC for the first time, and then we have Nadia Al-Hajji running the PIC, the petrochemical operations. Both of them have come through the ranks, very hardworking, super intelligent, and very credible for these positions. I believe that they will actually enhance the efficiency of the operation. They are very well positioned to make the necessary changes that are needed in the structure and the operations of. And now, the new refinery, KIPIC, the both companies, KNPC will initially started KIPIC, this refinery, but then they developed a new company and they separated it. And now Walid Al-Badr, who used to be the CEO for KNPC, is moved to become CEO there, acting CEO there, because the idea is the big change in Kuwait will be the merging of the businesses. So they will merge KIPIC with KNPC, they will merge KOC with KGOC, which is the entity that looks over Wafra operations and Khafji operations, and then they will merge KUFPEC with KPI. So this is all the international business will come under one umbrella. So there will be some kind of movements and the structure of KPC within the next 6 months. Nawaf, the CEO of KPC, is very, very keen on this restructuring to create more efficiency, synergy between the various entities.
Well, I think it's also perhaps the first in the region to have women leading the national energy companies. And I think you, Sarah, should be quite proud of the trail that you have set for your next generation on those announcements. So Mabruk to you and all your hard work over many years. Ahmed, I wanted to look at the outlook for this so-called oil price cap and the impact of the sanctions on marine-bound Russian oil, because we now have massively high oil tanker rates soaring to astronomical levels, as we have in our story in the News Digest today. Over $100,000 a day to rent yourself an oil tanker, because instead of just making the 3 or 4 day journey from the Baltics, Russia into Europe, they're now having to make 2-3 month journeys to Asia and back. How do you see the outlook for that and its implications for the oil markets?
Yeah, correct. Typically measured in terms of what they call ton-mile demand in the tanker market, which has increased significantly since this year. Not only for crude, but also for clean the clean product market as well. Yeah, I mean, in terms of this whole issue of it's trying to work out the sort of the tonnage availability. And then the balances involved for that, and then in particular, I think that the big key variable for Russia specifically is not only in terms of its own fleet that it has, but also looking at, as ton-mile demand goes up, then in terms of actual vessels that can be used in the market will be basically under pressure. But then I think that the kind of the trade dislocation, if you like, or the friction in the market that you're going to see perhaps develop over the next few months is more going to be around the what they call the ice class tonnage, because effectively where Russian crude is exported from in the Baltic ports and Primorsk and Ust-Luga, that's where you need effectively, you're going to have some of that logistical constraint as well. So that the ice class tonnage there, and people have suggested actually, well, Russia's deficit in terms of vessels, could be, between, sort of 40 to 50 Aframaxes to basically handle some of that. But then again, I think the big unknown is really around the number of there's been a huge surge in buying activity for secondhand tankers as well in the last few months, for those who want to actually, exactly as you say, take advantage of those high freight rates as well, and so and also the dark fleet as well. So the reallocation of tankers perhaps from that side of things as well. So that's obviously adding to some of the logistical pressure. In terms of the price cap, it's still very vague, to be honest with you, because
vague in its definition or vague in its likely impact. I mean, maybe one and one go together there, but
a little bit of both, because I think to a certain extent the biggest uncertainty is around, I think, the enforcement side of things as well. How will it actually be enforced? And also, quite frankly, in terms of policing that number as well, whose responsibility? I think there's already been, in the months ahead, some reluctance by insurers and banks to actually nominate themselves as, the price police, if you like. And also the EU alignment with the US around this. So there's already been some carve-outs, I think, that have been discussed. We'll see what happens today when they meet and discuss around that. But also, I think that, at the end of the day, this also relates back to OPEC Plus decision-making, I think, because in a situation where a refiner is, for example, not covered by term allocations and have to fight more aggressively into the spot market, does the effectiveness of the price cap get watered down by what's happening with effectively crude availability. And so,
I mean, it just seems to me like it's sort of this long labor delivery of this price cap into a moment in which it will be redundant on arrival. It just doesn't seem that the markets are telling us that this is an irrelevant story. Perhaps we're all with our head in the sand. I'm not sure. I wanted to come back, Ed, to the consideration of Saudi Arabia, because I do want to get a sense of how strong do we think they would be willing to try and defend $90 a barrel, or will they relent? I mean, it seems clear from August to October, the last meeting, they were quite determined to try and put a floor under $90 Brent. They talked it up, then they actually made the cut announcement, and now they're implementing the cut. Saudi Arabia has some very significant spending programs. You did say that other states may be operating like oil prices are at 70, but Saudi's operating like they're at 110. Between NEOM, the line, and every other, today's a public holiday because they won a football match. I mean, what's the cost of that? Your thoughts on how determined Saudi Arabia will be?
Yeah, I think the conditions kind of mirror what we saw in August, when we were seeing a similar deterioration in spot oil prices. The theme then was everything about recession. And then we had at initial stage the sort of verbal intervention from the Saudi energy minister, and then that kind of token cut of 100,000 barrels a day announced at the start of September for the October production targets. I would imagine that the conditions in oil markets probably satisfy those that would have prompted that kind of intervention. So we don't necessarily get a large scale cut, as both Sarah and Ahmed have alluded to, that doesn't seem really likely or really going to be effective in terms of who would be implementing that to take it forward. But I think we would get to see a more sort of full-throated defense to say that we cannot have volatility in oil markets, which interestingly for the Gulf countries always means when oil prices are falling. It doesn't mean when prices are declining, which is great if you have to fill your car up. But I think we probably will see some move in that respect. A kind of verbal intervention, if you want to use the kind of central bank parlance to apply to oil ministers here. But I think the uncertainty of the timing, right, with the EU sanctions and the oil price cap coming in the next day after the OPEC Plus meeting, probably means that it's a sort of wait and see moment to see how effective or how disruptive the sanctions are in terms of disrupting Russian crude.
I'm kind of surprised they never moved the date of that meeting, because the December 5th date from the sanctions has been known for a very long time.
Yeah.
And yet OPEC have proceeded with this decision to keep the day before, which would seem like one very large piece of information missing. But of course, they can always react soon again. Sarah, I wanted to get your thoughts. We've talked about this over the year. The move by most Gulf states, certainly the UAE and others, Iraq, to add production capacity, to maintain high levels of production capacity, that the supply chain has to be very, very busy. What is your outlook with declining quotas but rising capacity? How do those two things go together in 2023?
Sean, what is clear is that all the Gulf countries plus Iraq, that because I am involved in the operation there, I see they go through this seamlessly. So they just continue to add production. They continue to add rigs to drill more wells and to maintain more wells. They continue to increase capacity. So the price is down, the price is up. Their plans are just schematic and maybe there was a piece of news in Iraq, for example, that many of the MPs and the officials in Iraq, they are asking the oil minister to ask for more quota because they do have some little bit of surplus there. So they feel they should have a bigger quota than what they have now. And the UAE is the same stories. They are building capacity to achieve something like 5 million barrels. So they would need to be able to put that in the market. So all these countries are just going ahead with the plans as if there is no change, as if there is no volatility, as if there is no change in the current circumstances. None of them actually brought down any kind of plan or delayed any kind of feed or delayed bringing rigs. So in the industry today, in the region, it's really booming, and it is just going as steady as it can.
And Ahmed, your thoughts on that? Obviously, you watch Iraq very closely, as Sarah just mentioned Iraq. I mean, there's very determined intentions there now, even to get up to 7 million barrels a day.
Sorry, I was on mute there. Yes, I agree with Sarah that certainly for UAE, but also for Iraq, there is interesting developments going on the upstream. In particular, fields that act as swing, sort of production, like Majnoon in southern Iraq. They have actually advanced with a big well and drilling program in the last year, and also have very interesting plans for next year. But I mean, that's still has to be sort of put against the backdrop of, even if there was a significant revision to production baseline, how much more incremental real barrels can actually be delivered to the market, given the ongoing challenges in the export infrastructure right now. However, this is all like going on against the background of how this will feed into internal OPEC decision making, because effectively you could argue, theoretically, that there would be some sort of reshuffle of numbers based upon where constraints exist and where capacity growth that can actually be brought online. But it's quite a delicate matter, given the situation going on with the West African producers, Russia itself, and also on top of that, really the key players here are Saudi, effectively, because of just given effectively what the timing is, the sensitivity is, and also in maintaining internal cohesion as well. So I think whilst it's possible there may be some reallocation, I think that even for a country like the UAE, it is actually already putting out a bit more than its quota into the market anyway. So people disagree on that, but nevertheless, I think for Iraq, it's not an immaterial it's not an immaterial situation where it's going to make or break. It's for them.
Well, it does feel like that if we don't get these countries, Iraq and the UAE, clearly moving higher and higher, and unless there's some give somewhere, either demand increases significantly, it seems that we're somehow going to get to a point of tension there around production and quotas. Let's just get the last word from Ed on that point and get the survey question up on the screen for everybody to have a chance to vote on, which is on this whole OPEC point. What does OPEC need to do at December 4th meeting to keep Brent prices supported at or above $90 in Q1? No change, cut supply further, raise supply. And we've had all of those rumored and leaked in the media this week. But to keep oil Brent supported above 90 in Q1, what do they need to do? Ed, I wanted to give you the last word today and to bring into it China, because obviously China is the key missing piece here, but it's also, I wanted to get a more sort of slightly broader view, macro view on China weakness as a whole. This is beyond COVID by most analysis, although COVID grabs the headlines, lockdowns and so forth. But there's some structural challenges China faces, and yet the Gulf doesn't seem to be adjusting to the reality that their biggest customer and the sort of gravy train of the last 20 years is actually probably over, regardless of how quick COVID is managed in China.
Yeah, I think we are certainly transitioning into a structurally lower China growth story. I mean, you can look at the issues related to the property market. Tangentially, there will be a connection to COVID-19, but that's a lot of endemic overcapacity, failure to deliver on targets, those kind of issues. And I think a change in the kind of economic trajectory for what China is, that industry, exports is not just what's going to drive China going forward. And I think also worth bearing in mind that China is not necessarily a quiet geopolitical risk going forward as well. So the kind of ratcheting up of tensions that we've had between China and the United States, very highlighted in the tech space with the suspension of exports of chips to China, the US trying to build sort of this alliance of not sharing technology with the country, could be a prolonged risk going forward, that you sort of end up with this kind of capped level of development and growth in China, and that it might become not necessarily isolated in the way that Russia is today, but it's going to have to work a little bit harder, or the other countries are going to have to adjust their own policies in order to have a meaningful and long-lasting trade relationship with China. You can look to the kind of interaction that we saw the G20 last week between the Chinese president and the Canadian prime minister. Obviously, I'm Canadian, so watching out for that. Not a very constructive one, and maybe sort of in and of itself, not something very meaningful for China, but sort of a message that other parts of the world, the United States, Japan, the Eurozone should take notice of, that China is not afraid to let it be known when its displeasure has been irked by trade partners.
Yes, clearly that is the new posture of China. There's 30 years of quiet receding deference has now been replaced by the finger wagging, and perhaps that finger wagging might go to poking. We'll have to see. Let's get the survey result and wrap it up there. No change to keep 90 floor in first quarter, cut supply further, and raise supply, of course, which was the story earlier this week. It seemed rather odd. Nonetheless, who knows, maybe there's some geopolitics at work that makes the decisions going forward, or as I say, China could open, Russia could fall, and then more supply from OPEC plus would be needed. We'll have to wrap it up there. Sarah Akbar, as always, again, Mabruk on these great developments in Kuwait energy industry. Let's hope it's the beginning of a wave across the region. Some great female talent operating in the national energy sector, and it would be great to see them take up their rightful position at the top of the tree. Ahmed Mehdi, thank you so much for your thoughts. Thank you for getting up so early. It looks like it might be bright outside now, 7 o'clock or creeping out. Ed Bell, as always, thank you so much. Happy Thanksgiving to none of you, actually, because none of you are American, but nonetheless, it's Thanksgiving week, which is in itself a disruptor for the energy sector or the oil markets. I put up on the screen our heads up for January the 11th, our beginning of the year outlook for the year ahead, a big round the world virtual dial in for everybody, where we get all of our great commentators all in one day, giving us their view for 2023. We'll take obviously the holiday season off and start the new season with this blast across the world. Should be great, and hopefully all you guys will be there with us on that day. Take care. All the best.
Thank you.